Welcome to Inside India. I'm Amitoj Singh, and these are your headlines. Trade tensions escalating once again as the EU prepares to hit the US with potential retaliatory tariffs after President Trump threatened to impose tariffs on countries standing in the way of his plans for Greenland. China's economy holding up in 2025, meeting the government's target of 5% growth, despite bruising US tariffs on the world's second largest economy. We could see more headwinds for Reliance Industries, the conglomerate's quarterly earnings missing expectations on weakness across its major segments. While it was a mixed bag among the major banks, HDFC's profit rose, while earnings at ICICI fell. All right, let's get started with a look at the Asian markets. They've reacted to the weekend's news of the building tariff tensions between the US and Europe over Greenland. The Asian markets mostly slipping, apart from, well, the Kospi and the TAIEX. Remember, Taiwan's where the positivity is because of a deal that they struck with the US, and that continues to play out. China markets reacting to data around 4.5% economic growth. It slowed to its weakest pace in nearly 3 years in the fourth quarter as domestic demand softened, even if the full-year growth matched that Beijing's target of about 5%. Despite those growing trade frictions and tensions with the US and that prolonged real estate slump. So as far as China goes at this point in time, well, Shanghai is up, and that's particularly significant. The Hang Seng down. We'll be watching that space. Japan in focus because Prime Minister Sanae Takaichi holding a press conference at 6 p.m. Tokyo time later today to give clarity around the potential of a snap elections. That's why Japan's well, the Nikkei is acting quite cautious. It's biggest loser today, actually, along with New Zealand, which is 1.17%, the Nikkei at 0.97% down. And we'll be watching that because the Nikkei will definitely be reacting later tomorrow also. And we're watching other aspects of it, the yen and, of course, the bonds there. Let's also take a look at US futures because we've had yet another escalation on the trade front. Markets are closed today for Martin Luther King Jr. Day, but currently, as you can see, it's looking like the U.S. markets will be opening in the negative. Both the Nasdaq and S&P expected to dip about 1%. Now, President Trump doubling down on his Greenland ambitions, threatening additional tariffs on 8 European countries until they agree to let the U.S. take over the Danish territory. Countries including Denmark, Germany, France, and the U.K. will face an additional 10% tariff from February, and that would increase to 25% in June. U.S. Treasury Secretary Scott Bessent was on NBC's Meet the Press overnight, where he reiterated Greenland is a point of national security.
President Trump strongly believes that we cannot outsource our security because, Kristen, let me tell you what will happen, and it might not be next year, might not be in 5 years, but down the road, this fight for the Arctic is real. We would keep our NATO our NATO guarantees, and if there were an attack on Greenland from Russia, from some other area, we would get dragged in. So better now, peace through strength, make it part of the United States, and there will not be a conflict because the United States right now, we are the hottest country in the world, we are the strongest country in the world. The Europeans project weakness, the U.S. projects strength.
The EU is preparing for potential retaliatory tariffs of around 100 billion. The bloc is also considering activating the anti-coercion instrument, which has never been used before, that would limit US companies from access to the European market. It's the most serious rupture of transatlantic ties in decades. An EU emergency summit has been scheduled for Thursday. Futures for the Euro Stoxx 50 also indicating a lot of negativity when they open in about 4 hours' time. And currently, let's take a look at how they are looking. Well, down. We can see that. Yeah, 5970, that's where it is, 1% down. We're watching that. We're also watching, of course, the dollar and how it's consistently weakening since that news came out against, of course, particularly the yen and the Swiss franc. The news also sending the euro to a 7-month low against the dollar. The British pound also weakening to a 1-month low. Currently, both currencies recovering a bit from those lows. We're watching that development very closely. All of this is really setting the tone for the big event this week. Remember, it is the annual World Economic Forum in Davos. Trump will be attending with a contingent that includes his Treasury Secretary and his Commerce Secretary. He'll give a keynote address on Wednesday like he usually does, and on Thursday he'll be speaking to CNBC's Joe Kernan. Don't miss that. The Indian markets, they'll come online in about 45 minutes. GIFT Nifty futures, what is it indicating? Well, at this point in time, it's indicating that it's going to be opening a bit down, 0.3%. Expected to open on a weaker note. This has been something that's been expected since Sunday, really, after closing higher on Friday. A second positive in about 8 days of session losses. That's what happened on Friday. The strong earnings surprise from Infosys, kind of rekindling a risk appetite and lifting the larger heavyweight IT stocks. The market will also be reacting to a couple of big companies reporting earnings. Reliance has mixed earnings, and of course other major banks. HDFC did well, but not so much for ICICI. We'll get into that in a bit. But could the rupee strengthen since the US dollar weakened on Monday after the US President Trump's latest tariff threats against Europe over Greenland? At this point in time, remember, the rupee has weakened from what was thought of as a support price between 90.20 and 90.30. It's gone all the way to 90.71. So the rupee were under a cloud, really. Maulik Patel is the head of research at Equirus Securities, and we'll be talking to him about all of that. But before that, we want to get into what's happening with Reliance. Reliance Industries' Q3 earnings. That's going to play into the sentiment of what the market is going to really react to. We have to get a sense of why this is important first, because Reliance has been in the headlines not just because of geopolitical risks, sanctions on Russia, Venezuela. It has had to completely change its supply chain when it sources crude oil from these parts of the world. Now, it is also the biggest company, and as it reported its earnings, it missed profit estimates. Now, this was kind of expected, but it's about how much it's missed those estimates by. Reliance posting marginal 0.56% year-on-year growth. The total Q3 profit at 186 billion versus the estimated 196 billion, and this is the primary headline. Now, India imports about 85% of its crude oil need. Reliance processes 20 to 30% of India's imported crude oil, and it produces 30% of India's domestic natural gas. And the fact that it's missed its Q3 profit by about 110 million is significant. Now, why did this happen? It happened because of weakness in oil and retail. Both these sectors were under pressure, and that's what's emerged. There was tougher competition hampering the retail segment. And remember, when you talk about oil, you had to think about a couple of things, and this is what came out of the Reliance earning calls, that the executives there basically saying that the rates, the oil rates, they basically rose on vessels doing trade from Russia. There was pressure on the margins due to the supply chain disruption. They also said that the deltas in petrochemical have been low. They also said that sanctions forced sourcing adjustments, something I referred to, and that they had to approach national oil companies a lot earlier because of that. There were positives, though, for Reliance, and this is why it's a mixed result, that the OTC segment did well, 15% up due to higher demand for transportation oil, whether it be cars or jet fuel. And you also had another aspect that has kept this segment doing reasonably well, this company doing reasonably well. That's the consumer business segment, including telecom, digital, and retail. Retail not doing that well, but telecom and digital doing well because Reliance added 9 million customers and took their total consumer strength to about 515 million. And we have to think about the fact that you have a Jio IPO that's still awaited. 2.5% of the company will be floated, and these digital units that we talked about, their core earnings will be part of another company effectively, and those rose 16.4%. A big question around Reliance's Q-commerce entity, JioMart. Positive contribution, but cash burn. Cash burn continues to be a problem, and Maulik Patel is with us to discuss all of this and more. Not quite sure where to start, Maulik. There's so much to cover. That earnings call was perhaps the longest we saw in this entire earnings season. But let's start by just getting your first reaction to what you heard in the earnings call, I'm sure, and what you think about the sector in general.
So for Reliance, I think, as you said, that it's in a mix of numbers. The O2C is doing well, and it has been doing well because of the GRM, which is on one of the I think one of the best in the last couple of quarters. If you look at quarter two and this year to date, GRM is approximately $6.57 per barrel, much higher than the last year. And that's because of the transportation demand and the product disruption, which you can see because of the war, sanction, and other things. The pain was in the retail side. The growth was much moderated, and for the two reasons. They reported only 2% retail revenue growth, partly because of the two reasons. One is that the base, the The festival season has been mixed this time. It's partly in Q2, partly in Q3 compared to the last year, which was entirely in Q3. And second, they have demerged their FMCG business. But again, on the margin side, the margin were one of the lowest. As you mentioned that they've been investing into the QC. They claim that they have some 1.6 million orders in one of the busiest day. Earnings took on a dip because of the investment in QC. Now, what the steady part of the business is the Geo. Geo has been growing rock solid. There is an ARPU growth, there is an subscriber growth. The EBITDA growth is close to around 14%. And we believe that the Geo will continue to be on a steady path growth. O2C business will definitely have an ups and down. Refining part of the business is doing good. Petchem is another worst margin in what we have seen in the last 20-25 years. This continues to be on a downturn, and because of the excess capacities in China. So if you have to sum it up, Reliance is on a steady path, and at the same time, the new businesses in solar, in battery storage and others, they have invested close to around $8 to $9 billion, which is been investing on the last 3 to 4 years. And that will start materializing or start generating revenue next year onwards. But contribution initially obviously will be much lower, and we will wait for how they further expand or put a more capex onto these new initiatives.
Okay, let's just break that down into a conversation around retail, petchem, and then we'll talk about new energy. I want to start with retail because, one of the problems with understanding what's going to happen with retail, and this was kind of estimated forecast, that we're not quite sure about the data because for 3 months we don't get much data about how these quick commerce companies are effectively reacting, how the retail segment will react to whatever is happening. And we got this question that how they are managing to get to contribution break even, because even the number 2 player, assuming it's Swiggy, JioMart claims that it's the number 2 player on active subscribers. That's another thing that we have to dive into. Assuming that the number 2 player is right now not at contribution break even. And when the question around this cash burn came, that how are you going to have this positive contribution and margin despite this cash burn, it wasn't a clear answer in the earnings call. Do you have any foresight understanding of this?
See, one of the reasons is that they already have an ecosystem, and they've been trying to build this ecosystem through many years. They have also acquired a company called Denso a couple of years back. So they probably, giving the way that they allocate the expenses, and in their framework, it might be looking at a break even. Obviously, it's in the first quarter where they started giving the numbers. So, we will watch for numbers or the trend on those numbers in coming quarters. But yeah, in a QC, if you ask me, the competitive intensity is rising. Amazon is going strong in a couple of metros areas, particularly in the southern India, and they've been expanding slowly and steadily. Both Zepto and Swiggy, they have raised money in the last quarter. So everyone is with full of cash. And what we understand that the discount rates are rising, the delivery charges are coming down. So the competitive intensity is going to rise. That's what, and particularly for a lot of this QC, the metros, the densely populated areas are the where they make significant contribution, and where the competition is going to be there first. In case of Reliance, they have an advantage. They can go beyond metros because through their presence in Reliance Retail, their partnership with Kirana stores. So I think it's going to be in an interesting space over the next 2-3 quarters, how everyone behave and where the contribution margins are going to be.
Okay, do you see the petchem business, changing? Revenue fell 8.4%, core earnings down 12.7% for oil and gas. And I asked this because there were a couple of things that were said that stood out for me. The first was the use of the word sanctions in their earnings call. It was quite clearly mentioned that sanctions are forced sourcing adjustments. The second was this aspect of Russia and how there's been pressure on margins due to the supply chain disruption. And I think what was interesting to me, going a little deeper into the India story, was this aspect that a particular the maturing of the fields, particularly the 12% output decline in KG-D6 oil, the oil fields in Andhra Pradesh, those were mentioned as, well, reasons for why there's been this impact on the oil and gas segment of Reliance Industries. How do you see this evolving and changing?
Yeah. So I will take it in a two separate parts. Petchem is actually part of the O2C part of the business, where it clubs within the refining. Petchem spreads are one of the lowest today, partly because China consumes 30 to 40% of most of this polymers, either it's in a PE or PP-led derivatives. And the demand in China has been down because, as you know, that construction activities are not very good, plus the new capacities which are coming up in Asia. So the prices or the delta has been one of the lowest. I don't think that will change anytime soon, given that we have not seen material closures of those old facilities. Till the cycle doesn't make a bottom, till you have an old facilities going out of the market. So that's on the petchem side. That oil and gas or the upstream business, KGD6 obviously has the output is declining, but I understand that they've been rapidly declining over the next 2 years. The peak output at KGD6 was around 30 MMSCMD. It has now declined to around 26, 27. They don't have a plan to drill a significant new wells there. But if you look at in overall EBITDA contribution for upstream in overall part, it's only 7-8%. So that's contribution of upstream in an overall EBITDA mix has been keep coming down, and it has become in a very small segment for Reliance overall earning perspective.
All right, but India's demand for oil is expected to grow at a CAGR of about 4% over the next decade, so Reliance should be okay. And obviously the OTC segment that you mentioned, up 15% due to that higher demand for transportation fuels. I want to talk about new energy because that was a big part of the questions that came in, because there's, it's early days, people want to understand what's happening with that segment. Given the progress in commissioning those solar cells, modules, ingots and wafers and battery storage also, how quickly will Reliance's new energy segment really start to contribute meaningfully? I know you said 1 year, but meaningfully to revenue and profit.
I think that will take at least 2 years. These all projects are not coming at one go, and there are multiple phases within that solar cells, ignot, polysilicon, and everything which we spoke about. So I think full wrap up will take at least 2 years for them to commission. The intent is that what we know the Reliance, when they do it, they do it in a big way. They do it at a large scale, and they try to go it on a backward integrated way. So this is what they are doing it. This is the first time they are like in a new energy, which is like beyond oil. They have invested. So initially the investment plan was around $10 billion, which has been up now. If you ask me, the full potential of the earnings will be more visible 2 years down the line and not even in the next couple of quarters.
How will the markets react? Remember also Reliance you can mention, because it was 7% down the start of this year. In the couple of days in this year, it was 20% up last year. How will the market react to this?
I think on the earnings side, it's definitely a miss. We see some kind of a downgrade in earnings. Obviously, stock has not done that great in the first fortnight of this calendar year, first 15 days. But if you ask me, there is a downside support. There are some positive news as expected. One is in a Geo IPO. 2.5% of the companies, they will go for an IPO sometimes in this calendar year. Then there are some positive news related to the new energy and others. Quick commerce, analysts and investors will be keen to watch that, how the numbers are panning out on quarter-on-quarter basis. So if you ask me, and obviously the stock will open negatively most likely, but we have an ad rating on the stock. We see there is a limited downside given that it's trading at around 21, 22 times 1 year forward, similar to the what Sensex valuations or the Nifty valuation is that. And at the overall market, we believe that small mid cap will see a significant pressure. So this is one of the space where one can get some kind of a comfort.
All right. Final question about the verdict that came from the Supreme Court in India about Tiger Global and Flipkart's deal. the Indian top court ruling against Tiger Global in the tax case. And this basically means that Tiger Global's 1.6 billion stake sale in India's Flipkart will now be taxable. And the top court effectively is ruling this way because it believes that the Indian government proved Tiger Global used Mauritius entities to avoid tax. What are the repercussions of this, implications on Singapore particularly, and Mauritius? Mauritius perhaps having a lesser of a good reputation than Singapore, so Singapore entities will be, I don't know, reimagining the way they deal with India. But one other question about GIFT, because this suggests that Indian managers specifically will now set up in GIFT. Is that true?
So I've been watching that GIFT City since its inception, and we visited multiple times. If you ask me, pre-COVID, the number of active managers were very, very few. Now, what I see that every fortnight or a month, I meet someone who is wanted to set up a desk at a GIFT City. They want to hire people in a GIFT City. Earlier, so we know a lot of this Indian fund managers, the large like SBI, ICICI, many others. They have their AIF or some of the schemes they set up in a GIFT City, largely from a tax perspective, and because you got some 10-year window of zero tax. But also it's ease of the way that you can bring the money into the country and you can bring money out of the country. So I think GIFT will see a significant development. The regulator there is very, very proactive. They take stakeholders' concerns, their suggestions very, very seriously. And you can see there's a consistent improvement in the regulatory framework. Obviously, no place can be built in 5 years or 10 years. Probably in the next 5 years or 10 years, we will see much larger funds coming to the GIFT cities, private equities, VCs. You have alternate fund managers, equity managers, and I think this ruling particularly makes GIFT City much more attractive than what it was in the past.
And for Singapore, you're not worried at all?
No, I'm not. Singapore is a place where you can divert the capital to multiple geography. It's not only in India. And in Singapore, see, one of the reasons which I know that in Mauritius, the fund managers were not sitting. That's what I read in a newspaper. It's not the case in Singapore, right? You have another funds, entire team, setups in Mauritius, in Singapore, and take a decision.
All right. Thanks so much, Maulik Patel from Equirus Securities, giving us all that perspective. More news and updates on the other side. Don't go anywhere.
on the rise while maintaining stability. In terms of policy support, industrial self-discipline and production capacity adjustments are continuing to become more effective. This year, we will further strengthen regulation of production capacity in key industries, improve standard system.
China Stats Bureau there holding a press conference. A data deluge from Beijing really hitting us in the last hour. Our China reporter has been going through that data. Elaine, you joins us to make sense of all of that. Elaine, what is the latest data signaling?
Will be conducive to the
Yeah, Amito, this critical year-end scorecard is out, and fourth quarter GDP grew 4.5%. So that slightly beat estimates, but it's still slowing to a three-year low, and that brings the full-year GDP to a 5% growth. So that basically means China has hit its full-year target. But the underlying data in December shows that the supply-demand imbalance that we've been seeing is even more pronounced than expected. Industrial production grew 5.2%. That's beating expectations and faster than the previous month as well. On the other hand, retail sales, which is a proxy for consumer demand, grew 0.9%. It's missing a 1.2% estimate and was slower than the previous month as well. And in fact, this is the slowest in 7 months. Now, fixed asset investment, it fell 3.8% year to date, and this is missing a 3% contraction estimate and also a deeper decline than the previous month. And this is the first annual contraction for investment since records began decades ago. Now, Beijing has openly acknowledged this, saying that the economy has withstood pressures but maintained steady progress, but it noted that the contradiction between a strong supply and weak demand is prominent, is what the National Statistics Bureau said. So this is something that they're highlighting as one of the top domestic challenges for China. And analysts say for this coming year, in fact, domestic challenges can be a bigger hurdle than external challenges. Amitosh?
Thanks so much for that, Elaine. Coming up, big private banks in India reported earnings over the weekend. We'll get you details and analysis on the other side of this break. Welcome back. We're counting down to the market open in India. This is how we are shaping up. It's looking like it's going to be a bit of a negative start. Remember, on Friday, things were positive after many, many days, almost 9 days. Out of 9 days, 8 days were negative. And so on Friday, when you had a little bit of positivity, that was something that was, a good day effectively. And now what we are seeing is that it's going to open at about 25,604 after closing at 25,694. A couple of things will weigh into the sentiment is Reliance's earnings, banks' earnings. Another thing, of course, the weekend drama between the US and EU about Greenland, the threat of new tariffs. All of that playing into the sentiment. Additionally, we're watching the rupee because it's already strengthening. It was at 90.7. It's now at 90.65, given the US dollar's weakening against European currencies, particularly the Swiss franc. And we're also looking at the yen, as Japan may have, a snap election. Now, India's markets regulator, SEBI, has unveiled steps to ease foreign investor participation, including allowing large overseas investors to settle trades on a net basis instead of per transaction, cutting costs and funding needs. SEBI will also introduce a 20-minute closing auction session from August the 3rd to determine fair closing stock prices, aligning India with global market practices. The reforms aim to deepen markets and attract foreign capital amid heavy outflows driven by US tariffs, weak earnings, and high valuations. And let's now get a sense of how the banks reported their earnings. What did they really look like? Remember, Nifty Bank has been the positive story of the stock exchange in India, one of the main pillars supporting the market there for the past year into early 2026. The big question that really emerged was around a high LDR. For HDFC Bank, it was at about a 99%, and that signals that loans are almost eating up all the available deposits, leaving very limited and spare liquidity. So in that context, let me just get into how the HDFC Bank, India's largest private bank, reported its earnings. Higher than expected Q3 profit, a strong loan growth at 12% year on year, also 11.6% deposits growth year on year. But the fact that loan growth is 12% while deposits growth is 11.6% is where the question lies. And India's and HDFC's loan growth, while it's strong, margin was also improving from Q2 to Q3, beating these street expectations. Additionally, when you have margin improvement that's only gradual, that's where there is a concern. Operating expenses of HDFC is still elevated. That's another question that everyone seems to be asking amongst the analysts. And the other bank that we're watching, the second largest private sector bank, that's ICICI Bank. It also, is what has impacted the overall sentiment around bank earnings because HDFC was good, but ICICI Bank missed its Q3 profit expectations. Profit was down 4% year on year and much below estimates. So that's a big concern. Analysts expected a modest rebound or flat report, but that's not what's happened. Net interest margin remaining unchanged. You can see out there at 4.3% quarter on quarter. That's something that we're going to be asking our guests about. And profit really dip, the profit dip could rattle the sentiment for ICICI, and we'll have to see what the stock shares really say. We're watching this very closely, this particular impact. Now, why did this happen for ICICI Bank? Essentially, the Reserve Bank of India had flagged a portion of the bank's agricultural priority sector loans as not fully compliant with regulatory norms. Basically, this meant that ICICI Bank had to set aside an extra 1,200 crore as standard asset provision. That's 120 billion rupees. The impact is short-term profit reduction, but long-term financial safety and credibility improvement. But one thing that's impacted the market so far and ICICI's earnings, that's one understanding that we have. And the treasury performance wasn't as strong in the previous year. So let's get into it now with Vishal to try to understand what he makes of this. Vishal Goyal is India financials analyst at UBS Securities. Vishal, thanks so much for joining us. I really appreciate that. The biggest concern appears to be from these, earnings, and feel free to give your own opinion. What's your biggest takeaway? But the idea is that what we're hearing is the issue of loan to deposit ratios. That's the big concern. How will that shift from the late 90s, for example, with HDFC, to the 80s, which is what is the guidance given from the Indian government and what these companies themselves want to get to?
Yeah, hi. Thanks for having us. So I think one on the quarter and then we'll move to LDR. I guess the key question on the quarter, when we focus on profit growth itself, I think there are nuances, especially in this quarter. There were one-offs in this quarter, especially, as you already highlighted about the priority sector related, provisions or the cost. Plus, there is additional OPEX due to the new labor code, which, some of these banks are now incorporating. So earnings are, or reported profits are to that extent getting, impacted. I think it'll be wise to even look at the core PPOP or core operating profitability of these banks, which is what I think we've been kind of discussing about net interest margins. Are they getting better? For HDFC, it's getting better. ICICI, it's kind of flattish. For other sector, other segments, generally it's been flattish to improving. But when you look at last 12 months, things are kind of weak on margins, which is leading to lower or weaker profitability or core operating profit growth for most of the private sector banks, especially. Now, when you look into next year, I think the base effect will start helping all these banks, and their operating profitability also will start looking healthy. So that's part one. I think on LDR issue, yes, I think banks will have to contain their LDR, and some of them will have to maybe bring down LDR. But I think the regulator's stance on LDR is softened, it seems, and therefore banks are not in a hurry to bring it down. I think they have maybe enough time to reduce it.
So the question really is that is the market looking at the conversation around LDRs differently? Is it, I suppose, considering this a little bit more than it should, given that you're hearing from the likes of HDFC basically saying that we're not too obsessed about the number coming down in the early 80s. We're focused on trend lines and directions, and even if it is at 1994, we're fine with that. If you're lucky to step up growth, then it changes. So they're kind of brushing it away, shrugging it off. How do you view this?
Again, I think maybe not going on stock specific, but if you think about from a regulator's point of view, they know that deposit growth is actually going through structural weakness, and therefore they are allowing banks to operate at slightly elevated LDRs than whatever they would have expected. What it does is, in the medium term, it means that your deposit growth has to be higher than your loan growth, and your LDR basically normalize. But that doesn't mean it has to happen in next 6 to 9 months.
Okay, so we heard these earnings calls, and most of the banks were kind of positive on the idea of that they will get higher deposit growth numbers. But how? I don't understand that. That's not clear. How will that happen?
I think, there is, as we have seen for the last 3-4 years, so there is some structural shifts in the savings pattern. Plus, the nominal GDP itself is growing at like single digits, and that's has also been bearing, on the weak deposit growth. RBI is been, infusing liquidity through various measures, including the recent CRR, cut. That would also add to durable liquidity and durable deposit growth of the system. I think it'll be generally in the hands of RBI to keep adding durable liquidity, which, at the level they want to keep it. And it can't be too far away from the nominal GDP growth. So that's, I think, also another factor we need to consider.
Okay. Largely speaking, how do you see Nifty Bank and the market reacting to these earnings?
So there would be some, I think, divergence in the performance in this week, because the expectations into the results were very different for different banks. At the margin, I feel valuation-wise, banks are reasonably valued when I look at in context of overall Indian market valuations. Also, I think FY27 promises a slightly better earnings trajectory, given the base effect would start helping them because of weak margins, slightly higher credit cost for some of the banks. So that way, I think looks like a decent place for next 12 months.
I want to quote Suresh Ganapathy from Macquarie. He said that at over 81% of a system level, LDRs are now at all-time highs. And he's talking in the context of RBI, and I'm asking this because you mentioned the RBI will have liquidity under its control effectively. He said if the situation persists, banks may be forced to raise deposit rates or may have limited room to pass on RBI rate cut. both of which warrant caution. In that context, what do you think will happen with the RBI's next decision?
See, I think we have our official, economic forecast, which is that, there is possibility of another 25 bips, but we don't have those, as a high probability one. So that's where I think it is. And yeah.
Okay, not very high probability. Okay. All right. Okay. Talk to us a little bit about the labor code, because I think you mentioned it, and it's been at the higher side. The impact of the labor code, it's one time is what is assumed, but when you dive a little bit into it, you're not quite sure whether this will be actually a recurring impact on these companies, on these banks, on their earnings. What are the assumptions that have been made when you talk about labor code, given the rules have not come out yet, and that's being factored into margins and earnings in the report card?
Yeah, that's true. I think, companies are still working out on, how to build the impact of labor code, related costs. I think different people are building different assumptions. And at this stage, I think it's kind of, preliminary, and people are just estimating at high level and putting that in their P&L.
All right. I want to ask you a little bit about, this idea that foreign companies, banks will buy parts or more of banks in India. We've already seen that happen with Emirates NBD. They bought a stake with RBL. Japan's SMBC got the RBI's approval to buy about 25% of Yes Bank. What's your take on that? How do you see that playing out?
Yeah, I think this is kind of historic, right? Before this, it's been like more than maybe 25 years when, such kind of deals have happened. This brings in new capital into the country. Of course, it adds little bit of competition at the early stage. But I think at the margin, I think what's happening is the weaker franchise or the weaker businesses are getting, let's say, foreign capital. So it adds to the growth of the country. It adds to the, of course, competitive landscape at the margin. And, and unfortunately, in the last maybe 30 years, foreign banks operating in India, they have had very little success, especially when it, comes to retail lending.
Okay, what is your view on Tiger Global? We've seen what's happened with the Indian Supreme Court's judgment, setting a very interesting precedent, effectively saying that you might have an entity in Singapore or Mauritius, but if it isn't materially substantiable, then we can think of it as taxable income, and you can't use the bilateral treaties to get away with, the tax structure or the tax situation there. It's kind of rattled investors. That's one understanding of it in Singapore and Mauritius, perhaps more. What's your take on it?
Yeah, frankly, I'm not an expert on that, so I would kind of, refrain from commenting.
All right. Talk to us a little bit about SEBI on Friday introducing these several measures to ease foreign investor participation, including the trading session to determine those closing prices, and that proposal to, effectively let these large foreign investors settle trades on a net basis rather than per transaction.
Yeah, I think these proposals and many other proposals, I think, have been made over these years, and some of us have been making these proposals to SEBI, and it's great that these are getting some light of the day. I don't have a ready answer for the impact, but I think directionally it's very clear that SEBI is interested in increasing foreign participation.
All right. We're trying to understand how ICICI will recover from what has been a, not great result. Branch expansion and deposit mobilization support, loan growth above the system, that's the big question. Like, will that actually happen? How does ICICI recover?
I think we are not allowed to make stock specific comments, but I can give you a broad answer which will help on these large stocks. I think the system needs some deposit growth acceleration. That I think is key for all these larger players to report the growth which they were reporting, let's say 15-16% growth. And that I think would be the key for the larger players.
All right, Vishal, thanks so much for that and taking those particular questions in the broader context. I appreciate that a lot. Vishal Goyal from UBS Securities. All right, we just mentioned Japanese lenders buying stakes in Indian banks. A quick check on broader markets. There are a lot of events moving the index and the currency. Remember, later tonight, Prime Minister Sanai Takaichi will hold a press conference to reportedly outline plans for a snap election. And on Friday, that's when the regular diet session convenes. And Takaichi is expected to dissolve the lower house, paving the way for polls on February the 8th. Ruling and opposition parties are also reportedly mulling a potential 10% cut in consumption tax. And now that's according to the Nikkei. And the Bank of Japan decision is due this Friday. No change expected in the BOJ policy as it assesses the effect of its last interest rate hike to 0.75% in December. That hike may have narrowed the gap in rates with the US, but has hardly done anything to stop that downward pressure on the currency. The currency right now, well, it's strengthened just a little bit against the US dollar, but in the last couple of days, that's not been the case. The Nikkei's weakness also reflecting in the Japanese trading houses, an area where US conglomerate Berkshire Hathaway has a lot of exposure, and a big change came for Berkshire Hathaway when Warren Buffett retired as the CEO of the company earlier this month. But another thing that's changed significantly over the past, well, few decades, the amount of cash Berkshire Hathaway is sitting on, upwards of $350 billion as of the company's last report. Now, through the course of never-before-seen interviews, CNBC's Becky Quick spoke with Buffett about how his views on life, business, and philanthropy have changed over his lifetime, and his view on cash.
I know the cash, I mean, it's certain levels necessary, but cash is not a good asset.
Yeah.
You need oxygen. You don't need to be surrounded out. You don't have to pay a lot for it or anything like that. But you do need oxygen. and if you ever without it for 4 or 5 minutes, you will learn. And cash is that way. So you always need to have it available because you do not know what will happen.
And you can tune in tonight to Warren Buffett, Life and Legacy, right here on CNBC at 6 p.m. Singapore, Hong Kong time. Remember, Indian markets have joined the trading day. It's been about 2 minutes. We'll take a look at some of the big stocks reacting to their earnings and the latest in the Indigo saga. We're back in 2. Welcome back. The Indian markets have come online and Nifty 50 is down as was expected in the futures. We're looking at 0.4%, almost 5.5% down. 25,580 is the number we're looking at. Remember, the hope is that the bulls will get it to 26,000. That's a big question mark right now. Also, the rupee we're watching very closely. Two opposing forces, of course, foreign outflows. But at the same time, the dollar is weakening. And that's as a result of the geopolitical uncertainty, the new war, effectively, trade war between the US and EU over Greenland. Shares of Reliance reacting to earnings. The earnings were mixed. The oil and retail business didn't do too well. And that's why you're seeing it down almost, well, 1.5% really. HDFC Bank, good earnings, good report, but it's down about 0.6%. And ICICI Bank, where there was a problem, it was down quite a bit. The report card didn't suggest much positivity, and it's down 2.5% almost. And Yes Bank, muted some positivity there, so it's down 0.2%. But staying on earnings, Tata Technologies reported a sharp 96% drop in third quarter profit, hit by a one-time charge linked to India's new labor code, something that's playing out in various ways in other company reports. Also, net profit fell to just over 66 million rupees after the company booked a 1.4 billion rupee exceptional expense tied to higher employee benefit liabilities. Now, revenue, however, rose nearly 4%. Management says the impact is temporary, with margin pressures now behind it, and expects a sharp rebound in the fourth quarter, including double-digit sequential revenue growth. The share right now up about 3.5%. Maruti Suzuki is another stock we're watching because it will invest nearly $4 billion to set up a new manufacturing plant in Gujarat, adding up to 1 million vehicles a year in capacity. Production is slated to begin only in the year 2029, boosting Maruti's total annual capacity to 3.4 million vehicles. The expansion comes as India's car maker ramps up output to meet strong domestic demands and exports, with December dealer sales up 37% year on year, and an order backlog of about 6 weeks for entry-level models. The stock is up 0.2%. Quick look also at the shares of Indigo's parent firm, Interglobe Aviation. We're watching this and we'll tell you just why. It's up 3.5%. The air carrier getting a massive fine from the aviation body of India. Was it massive enough? That's the big question. CNBC's transport and travel reporter Monica Petrelli has the full story. Monica, when you look at those shares, what do you think?
Well, it looks like the market is okay with how regulators are dealing with the mass cancellations that we saw from Indigo back in early December. Now, at that time, Indigo said really a combination of factors are at play here. Everything from aviation congestion to weather to tech glitches. Oh yes, plus those crew rostering rules that came on board in November. But regulators saying over the weekend, issuing a note saying, well, no, really the primary causes: lack of preparation, deficient software support, management shortcomings, and an over-optimization. It's an interesting choice of words. Over-optimization of operations, saying that Indigo really focused on maximizing aircraft and crew to the point that it simply did not have a buffer system to effectively run the airline. Now, this has resulted in a fine, $2.45 million. Really, though, a drop in the proverbial bucket for Indigo's last fiscal year earnings. A bank guarantee of $5.5 million. Again, I think that the airline can absorb that. Probably more embarrassing, though, these warnings to senior executives, including its COO, and one ouster of an SVP. But really, all eyes on the CEO. What would happen to the very prominent Peter Elbers? He receiving something called a caution. This is lower than a warning. However, regulators did cite him for inadequate oversight of flight operations and crisis management.
Monica, thanks so much for that. We did expect, according to the analysts, when the Indigo crisis happened, that Peter would have to actually go, but that's not happened. That's interesting. All right. What about its competitor, Indigo's competitor, Air India? What's the latest on them?
I think Air India happy to be out of the news for a while, but it wasn't fully out of the news. Last week we saw both Indigo and Air Indigo getting caught up in the Iranian airspace closure. Now that only was for a couple of hours, but a lot of airlines avoiding the airspace. Even so, we could show a flight radar showing some planes now crossing over Iran. Most of those Middle Eastern carriers, a lot of the Indian carriers. There, you can see right there one a flight coming out of India, how they're routing around both Pakistan and Iran now to get to the United States. That's not good news for Air India, of course. Longer, costlier flights. But interestingly, one Air India flight left, got turned around because of the Iranian air closure, had to return to Delhi, encountered fog, and somehow, some way, with the limited visibility, a cargo container that was on the runway got sucked into the engine. So now Air India dealing with the fact that one of its engines on one of 6 Air 350s has this massive hole in it. Now we know repairing engines in this day and age, not easy to come by. And so that's not good news for Air India, of course. But we did see one perhaps spark of good news for the airline over the weekend. SIA and Air India announcing an agreement. More connectivity, perhaps sharing some frequent flyer perks, that news coming. Really, this probably a lifeline from SIA to Air India. We know the last couple of earning periods, Singapore Airlines doing good business in Singapore and in Southeast Asia and abroad, but seeing those earnings dragged down by its shares and its investment in Air India.
All right, Monica, thanks so much for that. We'll obviously keep an eye on both Air India and Indigo. But that's all the time we have today on Inside India. Keep watching CNBC. We've got Access Middle East coming up next. Thanks for watching.